This episode of It's Your Call is one of a series dedicated to facing the mortgage crisis in Southern California, brought to you with the support of the Corporation for Public Broadcasting. Good evening, I'm your host, Roger Bowman. With people losing their jobs and falling into hard times, many are wondering where they can turn to find help. And on the minds of most people is their credit. This evening, our guest will help us to understand how we can optimize our credit and hopefully obtain the loan modification we may be in need of. In the studio with me this evening are Tanisha Mason, Homeownership Retention Counselor from the Neighborhood Housing Services of the Inland Empire, and April Landry, Certified Financial Counselor for Springboard, a nonprofit consumer credit management agency. Also joining us from Springboard is Melinda Opperman, Vice President of Community Outreach. I invite you to call with your questions of our guests. Our toll-free number is 866-367-5827. Thank you very much for being here. Now, we have some housing counselor and credit counselor specialists here. So this is the perfect show for our callers to call and ask the questions about how they can qualify to get loan remodifications if they need it. Okay. So I want to just encourage our audience, be sure to call. Our lines are open. And let me turn to the first question. I have heard people actually say that they want to drive up their expenses and show a hardship in order to qualify for a modification. Is that the right strategy?
No, that's not the right
Melinda,
strategy. You want to be accurate in your financial situation. So there's no need to make things look in a more dire situation than they are. And there's also no reason to purposely be late on a mortgage. It's often called credit score suicide. There's some myths out there in the past where people thought if they made themselves late, it may solicit help. And with the programs that are currently in place, such as the Making Home Affordable program, there's no need to be late. One of the features under the plan for the refinance even mentions not being late more than once in the last 12 months. So no need to purposefully be late. You just need to be in imminent risk of foreclosure, that if you don't get help soon, you would have difficulty.
Well, I have heard that some of the banks are reluctant to engage you because you're not late, you're current, so you're not a problem yet. And they have so many people that are a problem, that are late, that they're foreclosing or are filing default notices for, that you just don't get the attention of the bank until you become late. So again, I ask you, do you need to do that in order to get the bank's attention and take that credit hit?
I say no. We do not encourage anyone to take a credit hit. Again, the Making Home Affordable program that became effective in April, it specifically talks about not needing to be late to get help. And I think it's an outbirth of possibly people thinking they needed to be late. Exactly. Now, I do agree with the logic of you would be triaged and may receive some help sooner if you're at the imminent steps of a foreclosure and a notice of sale versus someone who is acting proactively. But again, never purposefully, I feel, make yourself have late credit. There's other implications, as we're going to talk about. For derogatories on a credit report, you may have comparison shopping on automobile insurance. You may now be priced as a risk and now have caused your other consumer goods to have gone up.
Exactly. And also, going back to your original question, it's very important that consumers are accurate on their expenses, especially when dealing with your mortgage company, because they will receive a workout packet and they're going to have to put all of their income and their expenses, and they want that information to be as accurate as possible so that the lender can make the best possible judgment decision on their part to satisfy their loan and to put them in a workout packet that's going to work for them, a workout option.
Well, for so many people that are facing mortgage problems and they're having trouble paying their mortgages, maybe it's because of their job situation, maybe it's because of a reset of their loan's interest rate. They may be asking the bank either to do things like reduce the principal, stretch to 40 years, or reduce the interest rate, or all of the above. What's going to look best for the bank? What is the bank going to look for in saying yes to that modification?
Each bank is different and they all have different policies, but one thing I can say is the banks, they have a variety of different workout options that are available. And what they'll do is they'll look at that particular consumer and their situation and they'll design a plan that will fit that particular consumer's situation perfectly.
So does that mean every consumer in every situation has a plan waiting for them, or do they have to make some sacrifices first?
they're definitely, I would say 9 times out of 10, they're definitely going to have to make some tough choices.
Okay, so that's really what we want to explore. Let's talk about the credit aspect for a moment. A lot of the people that find themselves struggling right now maybe, and I don't want to characterize everybody, but may have made some poor choices in their expense side leading up to the situation. You're there on the front line. You're advising people. Can you tell us a little bit about what you've seen and what people are doing?
In terms of excessive?
They come to you, and the first thing you see is they may have some excessive expenses. What is it that you're typically seeing when they walk in the door?
Exactly. Well, typically what I see the most, what we look at as non-essential expenses, is the majority of consumers, 99.9, have a cell phone, if not 100%, has cell phones, but then by the same token, they'll have a home phone as well. And right now in today's society, you really don't need a home phone. Who even uses it anymore? So that's an item that can be eliminated to add more money to your budget. Also, there's the gym membership. That's something I see very often. Timeshares. These are the things that, and these are the areas which I call tough choices, where people have to make a decision and just get back to the basics and say, I can live without cable, I can live without the internet temporarily until my situation improves. How often am I using this timeshare that I'm maybe paying $4,000 or $5,000 a year for? Is it really necessary, or is me having a home, a roof over my head, more important? These are the choices that we're faced with today, and we have to make these tough choices.
April, you're saying something that I'm kind of incredulous to. Mm-hmm. You're suggesting that people will come to you and they're in potentially imminent peril of losing their home, and they still have their timeshare or their gym memberships.
Absolutely. In most cases, they feel they can't live without it.
Right, and I'd like to add that I've also seen where the homeowner is in danger of losing their home, but when we look at the finances, we'll see that they're spending $500-$600 a month in entertainment.
Exactly.
Like what is entertainment?
Going to the movies, going out to dinner, those type of things.
And that $500, I imagine, is pivotal.
Oh, absolutely. That could make a difference of whether a person remains in their home or not. And these are things that people, they don't really realize, or they don't look at typically until they come to us. Because at that point they're forced to, because we're looking at every single expenditure. And we're asking the question, is this something you can live without? Is this more important than you keep in your home? And so, I tell people all the time, instead of buying lunch, you're paying $5 a day, that's $25 a week. Why don't you take your lunch to work? You're saving $100 a month. These are the areas in which we encourage consumers on a daily basis to cut back in and to put these things into action. And these are some of the things that help people on a daily basis save their home. They're very simple. They're not earth-shaking.
And those are good
and
points.
They're not life-changing.
They're like lifestyle adjustments.
Exactly.
And so as you had mentioned the point about entertainment and the food, it's something that we all just kind of get an automatic pilot, and we get to spending things, and we all like the fast food. But when folks suddenly realize, hey, it costs 5 times as much for the fast food as if I'd prepare the meal at home. And so when they realize that, then they're also able to show how they've made adjustments to their budget.
Exactly.
And that's what the lender wants to see if we're looking for some type of loan modification. What have they done to reduce expenses? What sacrifices have they made?
Yeah. Another thing I bring to the attention of consumers, which is very helpful in them making these tough decisions, is, you eat out every single day or 3 or 4 times a week, and it becomes as a matter of fact. So you don't have that bonding, that family, bonding anymore. It's just, okay, yeah, we ate out, let's go home. If you do that once a month or once every other month, well, now it's almost like you're on a date. It brings more meaning to that family relationship. It's like you're actually doing something as a family and not just as a matter of fact. So there's a lot of benefits to cutting back in areas and not being, driven by society that we have to have gym membership. We have to eat out.
I expect lots of calls because you're going to talk a little bit about modification opportunities and how to work your credit to optimize your chance for a modification. But let's go ahead to our first call, and I'm going to go out to La Quinta. And I want to let all our callers know, please do listen in the phone, and you'll hear me in real time ask you to state your question, as opposed to listening to the TV, which is delayed by several seconds. And with that, let's go out to La Quinta. John, you're on the air. It's your call.
Yes, hi. A great program. I appreciate you guys.
Hi, John. What's your question?
Hi. Yeah, my question is on this loan modification. I am not going into default yet, but I just have become late on my first payment, or the first time in 40 years I've ever been late. But I contacted my mortgage company a week prior to me being late. I knew I couldn't make the payment because my wife and I, neither one of us were working. They put me through all kinds of stuff to qualify for a refinance. And when they came with my credit score, my FICO score, which has been diminished because of my borrowing against credit cards to make my loan payment all these years, finally they came up with 0.1% they could discount my mortgage at, would save me roughly about $20. I also talked to the people at HUD, and really there's nothing that the program that I know of, and I'm with the largest ones that there is in the United States, that can be done to people. I don't know any help I can get from this.
So talk a little bit about, and we've heard this before, people whose modifications are wholly inadequate. Does that happen very often in your experience?
So he's already spoken with a HUD-approved housing counseling agency and the modification wasn't sufficient. You then want to re-request additional counseling and ask to go back to a negotiator again in the loss mitigation department that the first modification wasn't sufficient relief, and ask for more relief and see if that's available. If that isn't satisfactory, then you want to make sure the housing counselor and the consumer are on a three-way call with the lender, escalate the call to the most senior person in the loss mitigation department, and confirm if there still isn't any help, and it sounds like this individual has some resources and wants to stay in the home. Then the housing counseling agency has an administrative website where they can email into Treasury letting them know that the most senior person at this particular lender is saying that they cannot qualify, they cannot make these adjustments, and that way then Treasury looks at those emails once a week and reviews them. They're looked at frequently, but there's a once a week meeting with all of the lenders there on the same call with Treasury why that particular person's situation was denied.
So you work in the housing and credit counseling industry. How hard is it to get the senior person at the loan, at the loss mitigation department of the lenders on the phone and talking to you and to the consumer that has the loan?
I would still suggest ask for the most senior person available. If the person is maybe not as senior level as maybe the consumer would like, still ask for the most senior level person and get that documented and then get that into the housing counseling agency, as I mentioned, into Treasury, whereby Fannie Mae has been tasked by Treasury under contract to monitor all those inbound emails so they can identify these trends, because so often the major banks would later hear so-and-so counselor called so-and-so at the lender and the consumer wasn't helped, but there wasn't enough specifics. Exactly. So the counselor's going to give the specifics, which was the most senior person they reached, what was the loan number, and what was some of the details. Because it sounds like he's got some resources and really needs some more relief.
He does.
Is it a true statement, and I'm not going to bash the banks entirely because I understand they are going through a triage process. They're just swamped. 15 million Americans live in homes that are upside down in value right now, and there is, according to Realty Track, going to be 4 million foreclosures or default notices filed this year. So I understand that they are a little busy, but is there, and I've gotten a sense of this, in the banks a trend of offering a modification which is token just to be able to report back to the government, for instance, that yes, they're modifying so many loans. Like they've modified 10,000 loans, but in fact some of them were token modifications that aren't going to help the consumer. Is that happening?
I don't see that from our agency in a sense that the modifications, there's a qualification process for it, just like qualifying for a loan all over again. So I've not seen any trends to what we would call predatory modifications.
Exactly.
No, I've not seen that.
Okay. We were talking a little bit before about the lifestyle modification, do you have people that fear peer pressure, or they are anxious about cutting back because they'll be seen as in economic difficulty by their peers, either at work or their family or whomever? Does that happen often?
I've seen that more, I would say, a year ago than today. Today, I think reality is set in with so many people, and actually, when they call, they're in a crisis, and they're looking for help. And the majority of the people are at a point in their life where they're willing to do whatever it takes, minus what their friends think. So in the past, I would say a year ago, I've seen that, and much less now.
So the pervasiveness of this problem has definitely had people accept this paring down.
Mm-hmm. Exactly.
Okay, another call. Let's go out to San Bernardino. Barbara, it's your call. What's your question?
Hi, thank you. Yes, my question's about a loan modification. My husband and I had to take out a loan on our home that we already owned back in 2005. It's neither FHA or Freddie Mac or Fannie Mae. We had a 2-year fixed rate, and then it went to a 12% international rate. We only owe like a little over $73,000. But we were wondering, is there anything that we can get help with, because we are on a fixed income, the two of us?
When you're indicating your fixed income, it's making me think, is that possibly retirement type income that you're receiving?
It's disability.
Okay. Would you mind letting us know what your age is, please?
59.
All right. Reason I was asking is at age 62, you become eligible for a reverse mortgage. And so that's why when I heard fixed income, I thought it may be for Social Security for retirement. But yes, you still want to work with a HUD-approved housing counseling agency and your lender to see if you're eligible for any of the loan modification programs that are there. And if you're not eligible, for example, for making home affordable because that particular investor doesn't offer that particular product, they often have other products that mirror it and are similar to it. The lenders we have found are in the business of wanting to have loans, not homes.
Exactly.
Right. So please, open lines of communication with your lender.
Good advice. Tell us about a reverse mortgage. Some people thought, since it's advertised on television, that it's absolutely a bad idea. And now that we're in this economic crisis, people are shying away even more. Give us a synopsis. What is it, and is it a good or bad idea?
It's something that there are some risks and obligations with a reverse mortgage. For an individual that's 62 or older, they're going to have the ability to take the equity, so to speak, out of their home and use that in one of three ways. They can either have a line of credit, or they can have a reserve amount where they can, write checks from, and they can also have an amount where they could receive a monthly stipend. So the neat situation for seniors is if their mortgage isn't too large, because there's certain limits and thresholds. If their existing mortgage balance isn't too large, the reverse mortgage will pay off that loan balance. Whereby now they are no longer needing to make a monthly mortgage payment. They still own their home. When they pass, their heirs still have access to the equity that's there. And then in the rare event they live for so long that they actually deplete any equity in the home, there's no way they owe more than the loan amount. No one's going to pursue the heirs for any residual.
And the best part is they don't have a mortgage payment anymore, and they can utilize the funds to vacation or have a wonderful retirement.
Yeah, and a lump sum amount to repair a roof.
But this is all predicated on the premise that people have equity in their home. A lot of people have found that depleted now.
Correct. So then they're, depending on the county that they're in, there's a threshold amount that they will loan up to. And then again, their existing loan balance, if it exceeds that, it's going to create a problem. We actually had a recent senior that we were speaking with that their loan balance slightly exceeded what the amount was for the limit. And for this particular senior who had received a small award from an injury, car accident, they actually bought down their mortgage so that it became exactly even whereby the reverse mortgage eliminated the existing loan balance, Roger, and guess what? No more monthly mortgage payment anymore. So now their Social Security that was coming in was simply theirs. There was no need to make a mortgage payment. They still have to pay their insurance for their homeowners and property tax.
Property taxes.
But still sounds like a good idea for some people.
For some people, and for others there could be risks. So it's something they have to really look at.
So let's take another call. We're going out to San Bernardino again. Janet, you're on the air. What's your question?
I had a question. My husband passed away, and I'm having a hard time making a payment. So what should I do?
Okay, that's succinct, but I'm sure you encounter that. You'll have to make some assumptions about the situation, but what do people do when they're on a limited income and it's now lower than what it was when they obtained their home?
I would seek credit counseling, housing counseling as well, because what they can do is look at her monthly income versus her expenses and see if there are options available, which I'm sure they are, and then also provide her with some resources to assist her, especially in this time, not only with her house, with her home or her mortgage, but also with her monthly expenses as well, and create a budget and an action plan to help her.
Tanisha, you do housing loan counseling.
Yes.
How many people come to you with that situation and can save their home and stay in it, and how many people find that they really are no longer tenable in that home?
Well, first we do review the financials of that homeowner coming into us. It is on a case-by-case basis, but after reviewing the financial situation, then we often make suggestions to homeowners, and when they follow through with those suggestions, then a workout for them looks pretty good.
So can you characterize for us, like half the people or a quarter of the people generally can stay in, or maybe it's the other way around, a quarter of the people really can't?
Well, what I've seen is about half of the people that actually come to us that the income has decreased, they're able to maintain their home.
Through some other kinds of either a workout on the loan, or I imagine reducing of the expenses that we were talking about, April.
Exactly.
Right. In most cases, it's a combination of both.
Of both, exactly.
Okay. And let's go out to another caller. Let's go to Corona. Loretta, it's your call. What's your question?
My question is in regards to loan modification. I applied for one in January, and it took me about 5 months to get the modification, and I was just treated cruelly and spoken to so unprofessionally by the loan company, by my mortgage company, and eventually they gave me a 3-month forbearance. Well, what happened is they told me that I could pay like 50% of my mortgage for just 3 months, and I had been off of my job for about 6 months. I had been in a strike.
And so, in this case, no modification, just the forbearance. Can you explain what is a forbearance? Go ahead, Melinda.
Okay, for a forbearance, the lender will be allowing you to not make any payments or a reduced amount for a specific period of time. It's like a deferment.
Right.
And so then they're going to re-review that. It sounds like in her case, after the 3 months, evaluate where she's at, and then determine if there's other loss mitigation options available.
Are forbearances hard to get?
I would say typically no, but it would depend on the particular lender, because each lender is different and they all have different policies, but as a whole, I would say I wouldn't think that they were difficult to get.
Okay, and in this case, I believe the caller was distraught that they didn't get a permanent modification that would help them, or something longer than the 3 months. She's been on strike for 6 months. In the case of a strike, you presume, you don't know when, but you presume that the income will resume once the strike is over. Whereas with somebody that's unemployed, you don't know what their new income level will be once they become employed. So isn't it a safer gamble for somebody that's on a strike?
And that's a good question, Roger. And my heart goes out to the caller. Mm-hmm. It could be a situation where they're going to go back at the 4th month and they may give an additional 3-month forbearance. Mm-hmm. So I've seen that where there'll be a series of 3-month increments of forbearances, and then when they're back on the job and there is income coming in, then they can look at potentially doing some type of permanent modification. But it's hard to make a modification because they don't know what her income's going to be. What's the result of the strike? Are they going to take some type of pay reduction?
Does a forbearance hurt your credit?
No, a forbearance is not going to hurt your credit. Now, if you've had habitual lates that are obviously out of someone's control, that's going to be there, those lates. And then it'll simply say, in forbearance, the payment's suspended. That's not going to impact the credit. And if they did get a mortgage late, it's not the end of the world at all. One of the most important things folks need to realize is that you can reestablish your credit quite easily. The FICO score will take points away for the slow pay, but the FICO score gives points right back for the on-time payments. So getting back on track with on time, and as that one late gets older, their score is going to improve.
Right. And one thing, a note to the caller as well, you want to be sure to keep that forbearance agreement. Make those payments on time. Do not miss a payment, because that will cancel out that forbearance agreement. So you do want to, number one, stay in contact with the lender, especially if you're running into a problem. But most importantly, you want to make those payments on time.
Okay, let's go out to another call. Let's go to Big Bear. Dennis, it's your call. You're on the air. What's your question?
Yeah, I wondered, you touched upon the part about the reduction of the email, where you would go to an email to Treasury Department.
It's a great tool that's been added to the tool chest of the credit counselors. So I would contact a HUD-approved housing counseling agency and ask if you can go through counseling, and then if you're not receiving the assistance you need, you want to escalate it and have that email step occur. And if you need any more information on that, feel free to give Springboard a call. You can even ask for myself personally. If you do receive my voicemail, it's just because I'm at an event like this. I'll be glad to call you back.
Great. Okay, so let's go to Montclair. Lorna, it's your call. What's your question?
I've been trying to get my loan modified for a couple of months, and I just want to know exactly how long does it take to get it modified.
Good question. And break that down for me, if you would, for Lorna, into how long does it take the bank to get into serious discussions, and then how long does it take to close the modification?
It could vary from lender to lender, and depending upon the amount of loan modifications they actually have that they're working on, which we all know is a lot. So it varies. Tanisha, would you?
And what I've seen is modifications that will take anywhere between 90 and 120 days.
Mm-hmm. That's from the beginning of the application to the actual creation of the new loan.
That's correct.
Mm-hmm. So 90 to 120 days. What happens during that time?
Well, if the homeowner is not making payments, and let's say there was a sale approaching, then what usually happens is that lender will postpone the sale because that modification is under review.
Okay.
A lot of times they will put the foreclosure proceedings on hold while the loan is being modified or looked at for loan modification.
All right.
Reviewed.
And let's go out to Corona. Loretta, it's your call. What's your question?
Yeah. Let's go out to Corona.
Well, yes, I called earlier, but I didn't get to complete my call. My phone hanged up. What I wanted to say is that my analyst I don't mind saying the name of my mortgage company, it was Chase Bank. And my analyst, she reported my income falsely. And I called and I said, well, no, she reported my income as $5,900 a month, whereas my income was $11,200 a month. She only looked at part of my income. And when I brought this to her attention, she told me that she wasn't going to change anything, that she wasn't going to do anything different. and that she was going to put me in the forbearance program, and that was all that she was going to do. She wasn't going to do anything to change it. I felt that I wasn't treated properly.
Loretta, I could see that. Let me ask, is your income, is it pretty steady, or is it like construction type income or something that varies a lot?
Well, my income is back now because I'm not back at work full time, but I'm back at work, up to least 70% now.
Okay, so let's go ahead and discuss for me, how often, these horror stories come in every once in a while, how often do you find that banks are going through what sounds like to me a perfunctory process of not getting the details accurate just because maybe they want to get through that process and they were going to deny it anyway? What do you think would be an explanation for Loretta's situation?
I don't have an explanation for it. Is your income fluctuating because they were looking at self-employed versus the take-home after the profit and loss? Is this a sole proprietorship?
Well, let me ask you, you do the evaluations for people. Do you take what you see in their, for instance, last year's income on their tax return and use that as the forward-going basis, or do you take what they just spiked up to like last month?
The lenders will send out what's called referred to as a workout packet, and they'll have to put in all of their income, their budgeted monthly expenses, and then also the majority of cases they do require their income tax return. So those are the documents that they use to usually utilize to determine what their income is.
Right, and not only do they look at the income tax returns, they also have they look at the bank statements and the paycheck stubs.
Paycheck stubs.
And the W-2, the business profit and loss, the bank statements, they want to see all of that. And then if the individual doesn't have their last 2 years' tax returns available, there's a form they can simply fill out and sign authorizing the lender to then request from IRS a copy. So they want to see those tax returns and those bank statements. They want to verify.
Exactly.
And I've not seen where they want to increase the income because why would they want to do that? Because that's going to make the person, if they can't afford to be in the home, that would just cause them to later they're going to default because they couldn't afford it.
Exactly.
So they want that accurate. They really want to know accurately where they are.
Okay, in this case, the caller had what looked to be underreported income, and if you were approached by somebody at your counseling services with somebody who was negotiating with the bank and the bank didn't reflect the accurate income, do you think that you could contact the bank and help somebody in that situation?
Definitely. We want things accurate. So if there was some confusion or mistake wherever it occurred, you would want to then say, I need to get this accurate and have it done accurately.
Okay.
Definitely.
We could do that.
Let's jump to another caller in Moreno Valley. How about Robin? It's your call. You're on the air. What's your question, Robin?
Hi, how are you?
Hi, Robin.
I've lived in Moreno Valley for about 10 years. I've owned my home for 10 years now. I find that it is more difficult for me to get a modification on my loan than it was for me to get a refinance. Seems like there's secrecy in the process, and I don't understand that. My income is not what it should be, but I can tell you this. I would be paying more in a rental than I am paying in my home. So I don't want to lose my home.
Okay.
What shall I do? What can I do?
So it sounds like she's most upset with the secrecy of the process, the void, and we've heard this a lot, that you submit it and you don't know what's happening.
Yeah, there's steps that the lenders will go through. There's a model, and it's called NPV, net present value. And they look at the value of the home, they look at the costs of keeping someone in the home versus foreclosure, and all of these variables. And a lot of information, if they go to makinghomeaffordable.gov on the website, it will talk a little bit about some of these steps. They do seem a little bit mysterious, but the lender has to show the justification for what they did. Exactly. And also we have to keep in mind there could be folks that, and it's not this caller's situation because I can sense the stress in her voice, but let's say there was someone who had a great amount of income and was trying to get a modification and get a 2% interest rate when they really could afford their going rate and their going loan. So that's why they have all these tests and require all this financial document, because you wouldn't want potentially a predatory borrower taking advantage of a modification when there really was no stress for that individual.
And there's people that actually need it, so they want to
make sure it goes to the people that need it.
Those,
right.
Exactly, that don't.
Okay, so let's go out to Paris and Daniel. It's your call. You're on the line. What's your question? And Daniel, hold on just a moment. I'm going to ask all of our callers to listen into your phone instead of onto the television. I know that's a little less convenient, but that way you can answer as soon as I go to your calls. We're going to take the calls as soon as we can. Daniel, you're on the air.
We have a situation where we own our house. We have a loan with Citibank. We're $100,000 underwater. So the problem is that my wife is on the loan only. I am not on the loan, but we're both on title, and we also have a second mortgage, home equity line of credit for $25,000 that we're both on. There's a we have excellent credit right now. We're above 800, but if we go into foreclosure, is there any way that I can salvage my good credit because I'm not on the loan?
Okay, good question, Daniel. A lot of people are asking that kind of a question. They know one person is going to take a hit, and they want to salvage the second person so that possibly they can buy again in the future using the other person's good credit.
Is this a situation where they can't afford the mortgage?
I don't think Daniel is on the line still. I'm going to assume that that's the case because he mentioned going to foreclosure.
Okay. Well, they can't afford the mortgage payment. And the reason I wanted to clarify that was if they could afford the mortgage payment, we sure don't want someone looking at that strategically to do that in a sense that there can be tax consequences, because he's got that second there, that HELOC, home equity line of credit. And so often with the home equity line of credit, there can even be the ability to seek someone out beyond what the securing it against the home. So there could be some consequences because he indicated both of them were on the HELOC.
Right. Talk about that a little bit. A lot of people think, okay, if I just go into foreclosure and I let the home go, I take a credit hit, but I walk away clean. Is that a myth?
It's potentially a myth because with some of the HELOCs, the home equity line of credit, it's like a credit card, and it's not always just secured against the house. They can also pursue you. So there's the terms of recourse and non-recourse. And with the HELOC, they may have recourse against both parties. So that's when he's talking about the bounce back on the credit, and he mentioned both were on the HELOC. He wants to do some research on that.
Okay. So let's go to another caller, Long Beach. Marcella, it's your call. What's your question?
Hello. My question is, I'm stuck in an interest-only mortgage, and I want to refinance it to a 30-year fixed. And I have some blemishes on my credit. My credit score has gone down due to a few late pays. And I would like to know how long it would take once I'm paying consistently on time every month to get my credit score back up.
Great question, Marcella.
You want to pay at least for a year, typically 2 years. But most importantly, Marcella, what you want to look at is your balances versus your credit limit. You want to keep your balances within either actually at or below 30% of your limit. And also pay on time, of course, but you want to be sure that your balances aren't really high because that will drive your score down as well.
So are there some quick tips that you know people can do to affect a positive change of maybe 30 or 50 FICO points that are often overlooked?
Again, people have the myth that if I just pay my payment on time, my credit score is going to be high, but if you're close to your limit and you pay on time, your score is still going to decline. So you do want to keep the balances relatively low within the 30 percentile.
Easier said than done, I imagine, with people that are already stressed and late paying.
Exactly.
But that was a good point, is she's like strategically going forward what she can do to reestablish her credit, and that's a good point as far as your credit score is your financial DNA. So anything you can do to improve it, as April was mentioning about keeping the balances down. So if you do have presumably a credit card with a $400 line of credit, you're looking at not wanting the balance to be exactly what the credit limit is, because then you're 100% utilized, you're maxed out. So following April's suggestion of keeping it to, at 30% of that $400, then you're going to show there's room on the account and you're not maxed out. And since utilization is 30% of your credit score, almost a third, that tip alone can help you tremendously.
So is the way to maximize your credit score to open more cards and spread the balances, do those balance transfers?
Well, you
10 cards with 30% instead of 4 cards at 100?
You want to stay away from the balance transfers. I don't recommend that consumers do that, because you can balance transfers to a 0% card. It's just for a short period of time. So now you have a lot of debt, a huge amount that could go up to 30% very easily. And you could very easily put yourself in the worst position by doing that. A lot of consumers think that's a good idea, I'll balance transfer, but it's for a very short period of time. And once that rate goes up, which it will, you're not going to be able to make those payments.
Okay.
And it also affects length of credit history, which is 15% of your credit score is the length of your credit history. So if you take someone like myself, who you can tell is a baby boomer, and I've got an account I've had for 20 years, but I decide I want to go out and get 5 new accounts all at once, then when it averages those 5 new accounts plus the one I've had for the 20 years, looks like I've only had credit for 4 or 5 years. And so opening up too many accounts can lower the credit score.
Oh, good tip. Okay, let's go out to Riverside. Kevin, it's your call. What's your question?
Let's go out to Riverside. Kevin, it's your call. What's your question?
Yes, is there a payment we can get to? Yes, is there a payment we can
Kevin, listen into your phone, not your TV.
Kevin, listen into your phone.
Is there a payment we can get to pay off our modification?
Okay. Did you catch that?
I didn't understand the question.
Sorry, Kevin. Let's have you ask the question again in just a moment. I'm going to go out to Beaumont and let Ed ask a question. Ed, you're on the air. Okay, Ed, go ahead and ask your question again. Ouch. Ed, you with us? Okay.
Roger, I think I caught part of it. I think he was maybe saying, do I have to pay for a modification?
Oh, that's an oft-asked question. Melinda, address that for us.
No need to pay for a modification. Never. HUD-approved housing counseling agencies, it's free. There's no need to pay for someone to help you.
Have you seen people going to you that have paid in the past?
I've seen several homeowners that have come to us that have paid $3,000, $5,000 to someone to actually do the modification for them, and no work has been done.
Exactly. And a lot of times it's private industries. A nonprofit organization would not charge you. What I urge consumers to do is, if you're considering going with a company for a loan modification, to go on the Better Business website. Look that company up. You want to do your research. You want to do homework. You want to know what their grading is. They have a grading for every company on there. Has there been complaints filed against them? Has there been lawsuits? So these are the things that you want to find out prior to going with a company, such as, one she's obviously mentioned.
Is it fair to say, because a lot of people talk about once they get a notice of default, mail comes to them every day, not just the collection letters, but the offers to help from perfect sounding organizations with the word protection and safe and hope in their names. Springboard, your organization does counseling, and Tanisha, your organization does counseling. Do you mail automatically letters out offering your services?
No, we do not.
The way those letters get mailed, a notice of default, foreclosure notice, that's a public record. And you have companies or private industries that they will go to the courthouses just to get these records so that they can target these people, and they will send out these letters to them.
So a lesson I've heard before, but I'd like to emphasize it, is there are qualified counselors who can help available.
Oh, absolutely.
But they have to seek them out. The homeowner, has to seek them out. Call 211 and get a referral.
Correct.
You have an 800 number. Let me offer that out.
1-800-WISE Plan.
WISE Plan. And, of course, you can always go to the kvcr.org site, click on Facing the Mortgage Crisis, and we link all the resources for your counties there. And it'll lead to your company as well, Tanisha, your company. And these are companies that are safe, are qualified, are legitimate, with professional counselors, and they're available for free. And the tip is, don't believe what you receive in your mailbox.
Exactly. And I would also like to add, consumers can always go on our website, www.credit.org, and they can look at the information for credit counseling, housing counseling. There's a wealth of information, educational materials as well.
Okay, I want to grab some other calls because every line we have is full. So let's go to Adelanto. I believe that's a city. Sylvia, it's your call. What's your question?
Hi, I'd like to know that if you undergo a loan modification and if your principal was reduced, are there any tax implications right now or in the future when you sell when the market is back up?
On the principal reduced, she actually got it reduced, or she's wanting to know if she...
No, if it was reduced.
If it was, so it hasn't happened?
No.
Okay. Typically what will happen, for example, under the Making Home Affordable program, or if a lender doesn't offer that, they'll have something that mirrors it, is they will typically, rather than reduce a balance by eliminating it entirely, they will defer the balance, whereby that balance sits there kind of, for lack of a better term, like a silent second. And no interest is accruing on it.
That's
it's
good.
Zero interest, and there's no payment required on it. Later, when the house is sold or refinanced or pays off, there's that residual that needs to be addressed. If the balance is eliminated, then yes, there could be what we call the phantom income, a tax consequence, because that has been forgiven and it has to be taken off the lender's books, and then the consumer would receive what they call a 1099. In that situation, we wouldn't want someone to be overly concerned that just getting the 1099 could be a problem. They want to speak with a certified public accountant, not just somebody who does taxes every once in a while down the street, but a CPA. There's some information on the IRS website, irs.gov. There's two features. One is the Mortgage Forgiveness Act, which was extended until 2012 for when some mortgage balances were forgiven, and there's some criteria there. Then there's another feature, and there's a form there that they discuss, and it's for mortgage forgiveness when your liabilities exceed your assets, and you may be able to have that forgiven. And there's a form that's completed, and CPA most likely wouldn't charge you more than about $75 to complete that form along with the tax return. So if you're hearing from one of the bad actors that we want to fight back against, it's charging some outrageous amount,
exactly.
Radar should go up.
Okay, I'm going to take another call. Let's go to San Bernardino. Frankie, you're on the air. What's your question?
Hi, thank you for having this show. I have a question. In order to pay down debt, what are the pros and cons of taking money out of my 401k to help do that?
Oh, good question.
I guess that's for me. One of the things you want to look out for is when you take money out of your 401k, there could be tax consequences, so you do want to check into that. And it's like a loan, so you are going to have to pay it back. Is it, sometimes it's worth it to do it, and sometimes it isn't. It just depends on the amount of debt that you have versus the amount of 401k. Your 401k is designed as a retirement plan, not as a savings to pay off debt. So I would use it as such and keep it as a retirement plan, what it's designed for.
Even if somebody has the potential of losing their home?
Well, in that case, then you would want to consider that as an option. But again, you want to look at what are the ramifications. Is it going to benefit me?
Okay. Let's take another call out to Lancaster. Raquel, you're on the air. What's your question?
My question is, how do Hi, my question is, how do you maintain paid off positive debt on your credit report beyond 15 years?
Oh, I imagine to keep it up.
That's a great question, because
question.
what can happen, and what the caller's probably familiar with, is you can pay off an account, and when it goes dormant, it can, after so many years, kind of fall off the credit, because it does cost the credit grantor money to report that history. So we recommend for folks that have an account that they use it, once every 6 months, once a year. We certainly don't want to encourage carrying large balances, but we all have to make that one gift or buy that one pair of socks, buy it on the account, pay it off in full, so that you keep the accounts active and they don't go dormant.
Oh, good tip. Okay, so let's go out to Desert Hot Springs. Mike, you're on the air. What's your question?
Hello, thank you for having me on the air. I've been trying to get my loan modified for the past 10 months with my lender. Back in August, I became unemployed. I lost my income, and I reported to the bank that I'm not going to be able to make any payments because of loss of income. Shortly after, I was able to recover my income for several months, and that kind of put me into a qualification for a modification status. And since 8 months ago, I have got into a new job that I'm training on a part-time basis, and my income has increased. It has decreased by about 2/3 of what I was making 10 months ago. And I have so far also invited a roommate to share a room so I can offset my expenses that way. I'm facing a fear that if I call the bank right now, that since they may be thinking about an income that I had that was different than now, that could possibly automatically disqualify me for the modification and put me into a foreclosure situation.
Mike, I understand. I've heard this before. People that are afraid to communicate with their bank, bad news, because if the bank is optimistic that in this case Mike will resume his prior income, then he can afford the home, and the bank may be anticipating that. Whereas with his new program that he's training for, he's going to permanently receive less income, and he's worried that he'll fall away, and he'd rather, of course, stay in his home as long as possible. What do you advise?
I advise to open the lines of communication with the lender, because it sounds like he's in a situation where he kind of feels like he's eventually going to circle the drain, and so right now he's just going to kind of delay the inevitable. Eventually something is going to happen, and of course I don't know who his specific lender is, but things have changed since last October. We saw a lot of changes in April and May, new programs, new tools to our tool chest for housing counseling, so there may be even an additional program to help him.
We're tight on time. It sounds like what he can do is contact one of your organizations. Can you give me a 30-second quick plug on your organization, Tanisha? You've been too quiet.
Our organization is located in the city of San Bernardino, where we do provide post-purchase counseling, foreclosure intervention and default counseling, and also pre-purchase home buyer education.
Great.
And financial
Let's
fitness.
take one more call, and it's going to be quick. Quick call, quick answer. Let's go to Long Beach. Elaine, what's your question?
Hi. Thank you so much for taking my call. I wanted to know what is the credit consequences of, I had 2 Capital One accounts, and they sent me notice that they were going to increase my APR. So I said no, thank you. And as a result of that,
Elaine, I'm going to interrupt. Summarize your question crisply for us.
Okay.
Can you give me the summary of your question? Didn't want to lose you.
I wanted to know what the negative results of that is, and I also wanted to know, is there anything going to be done about our sector of renters about what has happened with the mortgage crisis?
Okay. Give me about a 30-second response if you can.
On the credit cards, it sounds like she's saying she doesn't want to have the increase in the interest rate, which is understandable. Call in, ask for customer service, ask for a manager, do your best, see if they will go ahead and reconsider and reduce it. If not, it sounds like then the accounts get closed. Her next step is, with those accounts getting closed, is reach out to her local bank, credit union, ask them for a card, so that then she can still keep good credit history. On the renters, yes, there's been some new legislative news. If you're a renter in a home and it goes into foreclosure, there's a 90-day time period. You have to relocate, so there's that 90-day window. However, if you knew that in 30 days your lease was going to expire, you'd have to vacate then. So know there's some new changes and reach out.
Thank you, Melinda. I'd like to thank our guests, Tanisha, April, and Melinda, for joining us this evening. And thank you to our viewers for watching. If you'd like more information about tonight's show, go to kvcr.org, click on Facing the Mortgage Crisis. Please join us next week. I'm Roger Bowman, and remember, it's your call.
For more information about this project and related topics, visit kvcr.org and click on Facing the Mortgage Crisis.